The Fed can't wait to respond to the coronavirus. That was you in the Wall Street Journal in late February. I think pretty much every single one of us on this program agreed with you. Now the conversation has switched almost 180. Has the Fed stepped in too far? Has the Fed done too much? Kevin, how do you respond to that now?
Yeah, it's a great question. Good to be, Tom, with you and Jonathan. So I'd say a few things. First, when the regime changed in February of this year, that's the job of the central bank to be super aggressive. And the earlier you can be aggressive, frankly, the less you have to do later. So they moved, not with the speed I would have liked, but historically speaking, pretty quickly. When you look at where they are now, they seem to be moving with overwhelming force. They seem to be incredibly aggressive, even as risk assets are at incredible highs. I wish that same aggressiveness were being felt in the policies they were putting on Main Street. In Main Street, their policies seem to be late, delayed, cumbersome, and frankly, not terribly effective. So that chasm between the aggressiveness to push up risk assets and push down bond spreads doesn't seem to be matched on Main Street.
Do you think the focus on one over the other right now is leading to market malfunctioning? They say that every single point objective is about market functioning. I just wonder whether the efforts now are impairing market functioning, Kevin.
Yeah, listen, it's hard for me to say with a straight face that markets aren't functioning well. And that rationale for policy action was astute 60 or 80 days ago. It's really hard for me to say that the aggressive policies, the doubling of the Fed balance sheet, entering bond markets that we never thought about entering in the last crisis, that we're doing that because markets aren't functioning now, that explanation isn't great. And my own judgment is monetary policy matters at least as much for the reasons it gives as the decisions it makes. So I think that rationale is certainly in need of some updating. And if I look at what's happening in markets, with the Fed having this kind of massive imprimatur on financial markets, it's easy to see how they're moving around financial assets. But what ultimately matters, Jonathan, is what you said at the beginning, is what about the real economy? And again, it doesn't appear to me as though much of this is trickling down to the real economy in a meaningful way from the Federal Reserve.
Well, Kevin, is that the Fed's job? I mean, the Main Street lending program is very new for the Fed because they're going to be taking on credit risk and becoming responsible for deciding who to lend to, how to lend to them, when to force some companies into bankruptcy. Should the Fed even be doing this, or does the responsibility lie elsewhere?
So the responsibility really lies in the Congress to come up with what can be done on the real side of the economy. They outsource that responsibility to the Treasury Secretary and the Exchange Stabilization Fund. And then the Treasury took much of their authority and devoted it to the Federal Reserve to stand up this Main Street credit facility. Jonathan was kind at the beginning to talk about a Wall Street op-ed I wrote. I wrote about this Main Street credit facility with a much worse name than they gave it about 3 months ago. And what my principle there is something they frankly haven't adopted, which is provide ample and immediate liquidity to all solvent comers on Main Street with immediate effect against good collateral. But that's not the way the Main Street credit facility works, at least as they've iterated it now several times. I think you're right, Lisa. It's not the Fed's job to be deciding on every loan, but the good news is they happen to regulate 5,000 banks. It is their job. And so again, if I were to have designed that facility as I wrote about 80 days ago, the Fed would have regulated the banking institutions who would have provided loans to their typical clients against good collateral based on their solvency before the crisis. And the only job the Fed would have would be to ensure that the banks would have done proper underwriting. If they would have underwritten a loan to a widget manufacturer in Toledo on February 1st, and they follow those same underwriting standards, then that's a good loan. Any losses that might be had, and surely they might, those losses would be offset by the money that the Treasury Department had granted to the Federal Reserve. I prefer that kind of immediate and ample liquidity to this kind of picking and choosing, and to see the aggressiveness again in financial markets and the lack of aggressiveness, the slowness of response in Main Street, it makes me actually quite concerned about the real economy.
Well, let's talk about what is going to happen in the future, not perhaps just taking a look at what they should have done. You wrote in a recent op-ed in the Wall Street Journal that if policymakers get next steps wrong, 2020 will look a lot like 2008 in terms of the sanguine feeling right now turning into catastrophe later in the year. Do you see policymakers on that path right now?
So, we should begin with what Chairman Powell's word is of the moment, uncertainty. We have to have epistemic humility about what we know and epistemic humility about the efficacy of these policy tools. I'd feel a lot better, Lisa, about the state of play and the risks over the second half of the year if we had used the decade before this crisis putting our own house in order. Chairman Powell said how it would have been better if Congress had been more fiscally responsible in the decade between these crises, so it would have plenty of flexibility and plenty of credibility to provide massive increases in debt. I think the same is true of the Federal Reserve. Had the uncertainty principle, which they talk about frequently now, been what they talked about between 2010 and 2020, the Fed would have come into this process with a lot more traditional ammunition. It wouldn't be having to reach into all these new markets with uncertain effects. So as I look at the second half of the year, Lisa, what I'd say is a W looks a lot like a V until it turns out to be a W. And none of us really know the contour of this economy. I guess what I'd say as a final word on this, if you were to take an Olympic swimmer and a novice swimmer like me, and you locked us down at the bottom of the pool, and then you finally unlocked us, well, we'd both be racing up to the surface at some point. But that wouldn't really help us understand who was the Olympic swimmer who was ready to go do 100 laps and who was the guy just trying to get his head above water.
Kevin, I've got this image of you and Stanford's water polo team just getting it done out there against Pepperdine. I can just see it coming. Kevin, you are identified more than any economic official and policy official with Republican politics and, of course, the storied family you married into. I don't know if you grew up on third base, but you're decidedly living on third base. From your view and with the honesty you've had for decades, are we moving ourselves towards an ever more gilded age? Is the price of all this funny money and policy that in 2025 or 2030, we are going to be ever more unequal?
Well, Tom, I should first disabuse you of your visual, not least of me on the water polo team. I can hardly swim, and I grew up in a regular family in upstate New York, and have parents that are probably so excited to be watching you on TV right now. But in terms of the substance of the question, which is really where at this moment of consequence we really should be focused, I would say because we've had an aggressive central bank, not least in times of crisis where we need a central bank to be an emergency authority, but in ordinary times, treating that like it is an emergency, like we've had an emergency every day since the darkest days of 2008, these kinds of aggressive policies do lead to misallocations of capital, do lead to financial assets that trade better than real assets. And there's a certain unfairness to that. So that's why this is no time to be trying to have a philosophical discussion inside the four walls of the Fed. But the idea that they should have been fine-tuning between 2010 and 2020 instead of thinking ahead towards what are the risks, you end up with policies now that I'm afraid do tend to take the income inequality and, more important, balance sheet inequality, and we make it somewhat unfair. Half of our fellow Americans have not been able to benefit because they don't have equity in a 401k plan or in stocks. They don't have equity in their house. So as they look at the run-up in these markets, they ask themselves the question, what's in it for me? And that's why, again, the Fed's focus should be on the real economy, and we'll let financial markets take care of themselves.
Kevin, I'll get told off for squeezing one more question in, but I've got to. That's the comment on monetary policy. What about fiscal and making sure the house was in order there? You touched on that. Is that another way of saying that tax cut a couple of years back was a mistake?
So what I'd say is fiscal policy has a certainly important role to play. But Jonathan, too much of the discussion is how big should the next stimulus bill? Frankly, the size of these stimulus packages mean a lot less important than the design of them. So when I think about tax policies then and tax policies today, tax policy and fiscal policy more broadly needs to be designed to encourage investment back in the services sector of the economy, back in the real side of the economy, instead of financial flows chasing the S&P at these historic levels. So as I think about the next stimulus bill, which they say will be somewhere between the 4th of July recess and August, my encouragement, my overlying counsel, I would say, to the authors of that is make sure that there's incentives for real people to re-engage back in the workforce because they've been displaced, and real investment find its way into real property, plant, and equipment. Again, I shouldn't say this in front of a news show where so many of your listeners are investors. We get the real economy to do the right thing, and I don't really worry about the S&P.